Philosophers and phenomenon, each must know his part to sow a new mentality closer to the heart. Yeah!
It's David Morgan with the 10 rules for silver investing. Rule number 1. When all else fails, there is silver. No one likes to be a prophet of doom, but the simple truth is that silver is the world's money of last resort. Should a severe economic collapse occur, leaving paper assets worthless, silver will be the primary currency for the purchase of goods and services. Gold will be a store of major wealth, but will be priced too high for day-to-day use. Thus, every investor should own some physical silver and store a portion of it where it's accessible in an emergency. Rule 2. Start small. Keep it simple. Too many investors, upon deciding to beef up their metals portion of their portfolio, buy too much physical silver at once and in the wrong forms. Beginning metals investors should concentrate on pure bullion bars or coins in smaller sizes, looking to pay a minimum premium over the actual melt value. Avoid commemorative coins, decorative items, jewelry, and other collectibles, all of which carry a large premium and have limited resale markets. That's the rule. I'd like to add on to that briefly. I'm recording this in August of 2011. Right now, and it has been true for quite some time, and is also generally true, that junk bags, which are 1964 U.S. minted coins or older, are 90% silver, and they usually carry the lowest premium. I think that that's a good way to start buying metal, but obviously they're rather cumbersome, but it is a good way to start, and it's also one of the better barter items if it ever came to that. Not necessarily that it would, but it could. So something to bear in mind if you're looking for the best value. Check out a junk bag or half bag or quarter bag or even rolls of quarters, dimes, 1964 or previous. Rule 3, boost the buying power of your dollars with mining shares. If you are a typical investor, you cannot expect to be an expert on silver and the silver market, but you can invest in the people who are. Once you have established a core position in physical silver, leverage both your knowledge and your buying power by purchasing the stocks of mining companies. These shares are highly responsive to changes in the silver price, frequently producing much higher percentage returns than the metal itself. Again, I want to add on to this rule. This is true. However, in the last few years, the mining companies have not really kept pace with the bullion itself. If you go back from the inception of the bull market, many of these companies have produced spectacular gains, some as much as 10 times the investment, 20 times investment, 30 times the investment. One particular one that comes to mind is Western Copper, which became Western Silver, which was bought by Glamis and eventually bought by Goldcorp. That mine is now in production. And that, I think, was about a 30-bagger. But the point I'm making is that recently the stocks have not performed. I think this spells opportunity. Certainly, a lot of our work focuses on the mining shares, but that's not the total thing we focus on. We look at money, metals, and mining. And certainly you don't need to subscribe to the Morgan Report. You can certainly look at other avenues to do your own research or determine that all you want to focus on is the metal itself and not involve yourself in the mining shares whatsoever. I just want to go on record as saying I still believe that there are great gains in the mining shares ahead of us, but you've got to be careful, you've got to be selective, and you've got to do it in a manner that takes risk and reward into account. Rule 4, dollar cost average to lower your costs and increase your discipline. Dollar cost averaging is an ideal way to implement Rule 2. By making same dollar purchases at regular time intervals, you wind up buying more metal when prices are low and less when prices are high. This approach helps you develop discipline, erasing the trader mentality that infects many market participants and instead focuses an investment philosophy. Dollar cost averaging also eases the sting when prices move against you, allowing you to view the downturn as an improved buying opportunity rather than a disappointing loss. I really like this approach. This is one of the main approaches I teach for the buy and hold members of the Morgan Report. It's a great way to come out in the long run very, very well, especially if you diversify properly. You mix the correct blend of mid-tier growth companies with speculations, and you, again, spread out. This is a very tried and true and proven methodology. I like it a great deal. You buy more silver or gold when the price is low. You buy less when the price is up. It still is disciplined, and in the long term, you will come out in a very good manner as long as we're still in the bull market, and I believe strongly that we still are. This is David Morgan with the 10 rules for silver investing. Rule 5, do not get a raw deal from your dealer. Because of the specialized nature of the physical metals markets, selection of a well-established dealer with a quality reputation is essential. A good dealer will provide timely execution of your trades at fair prices with reasonable fees. Note that the lowest price is not necessarily the best price. In the past, some dealers who squeeze their price margins too low in order to attract clients were unable to make delivery, leaving those clients holding the bag. I'm going to digress here slightly and talk about one that I'm very familiar with. It was called IGBE, International Gold Bullion Exchange. This took place during the last bull market in the metals, which was roughly 1970 through 1980 early. And International Gold Bullion Exchange was saying buy gold at spot. And they ran full-page ads in major newspapers like the New York Times, San Francisco Chronicle, LA Times, that type of thing. Full-page ads, buy gold at spot. It turned out to be a complete and total scam. And many people bought into it because people like to get the lowest margins or the lowest premium. I don't blame them. But there isn't anyone that can buy gold at spot, to my knowledge, in the retail market and even in the wholesale market. If you buy directly off the exchange, you're buying the spot price, plus there's a few fees. There's a fee that you have to pay to clear some paperwork. There's a few days storage. If you take immediate delivery, you still have to pay a storage fee for a few days. Then there's a shipping cost to get Brinks or whomever you elect to come out and drop it off at your bank or your office or your home or wherever you're going to take delivery. So just be careful. I'm not saying you have to pay a huge premium. I'm just saying that if it sounds too good to be true, it probably is. Rule 6, what's yours is yours, so keep it that way. While it's wise to keep some of your silver where you can get it easily, it's also important to keep the bulk of your metal in a safe place, especially as your holdings increase. However, if you establish an account with a brokerage warehouse or other public storage facility, you should make sure that your holdings are kept segregated and that you can inspect them when you wish. I don't want to go into every definition here on allocated, unallocated, and segregated, but you can look it up on the internet. Let me just say that segregated means that what you own is segregated from everything else, and you'll get back exactly what you put in, if it's truly a segregated account. So as a quick example, if I sent in 2 silver bars and 4 gold Krugerrands, and for whatever reason I decided to put big X's with a nail into my 4 Krugs. When I got my 4 Krugs back, there would be those exact same Krugerrands and those exact same bars. That's a segregated account. An allocated account isn't as well defined. It means that the metal that you put in, you'll get back the equivalent. So if you put in a 100-ounce bar, you'll get back a 100-ounce bar. If you put in a 1-ounce Krug, you'd probably get a 1-ounce Krug, but it might not be the exact one you put in there. Unallocated is rather risky in my view, but of course you have the final decision on that. Rule 7, silver speculations like cough syrup, good in small doses, but too much of this can make your portfolio sick. Depending on your individual goals and your personal tolerance for risk, a small portion of the assets you commit to silver can be used for speculation, perhaps in futures or options, or even other ETFs or that type of thing. But never forget, that type of trading is speculation, not investment. Rule 8, A little information can mean a lot more dollars. You do not need to be a student of the silver market to profit from your metals investments. However, you will greatly increase your chances of success and the size of your potential profits if you understand the fundamental factors that drive silver prices and pay regular attention to current supply and demand considerations. Rule 9. Collecting silver is an art, but not really an investment. Owning fine silver items, including rare coins, can provide great enjoyment and personal satisfaction. Like paintings and other artwork, they are beautiful and often quite valuable. And if you're an astute buyer and seller, they can generate large profits. In spite of this, however, always view such holding as collectibles, not as investments. When you need your silver or simply want to cash in, you do not want to have the difficulty of selling or being forced to forfeit a large aesthetic premium, both of which are likely with silver rarities. Again, I'm going to add to this rule slightly. If you're very astute at coin collecting or rare coins and you really know what you're doing, certainly, I'm not going to tell anyone what to do. All I'm suggesting is that most people are better off just buying coins that are in the bullion variety rather than get into the rare coin field. Again, if you're really up for it and you devote the time and energy that's required to do well at it, by all means, press on. For most people, it's really a difficult market. And there are times when these markets are difficult to sell. So just be advised. Rule 10, more than 10% is too much of a good thing. No matter how good the market looks or how worried you are about the future of civilized society, you must always remember that silver should make only a portion of a well-diversified portfolio. I recommend committing 10% to the average portfolio to silver, regardless of how strong you feel about the potential of these metals markets. Now, I wrote that years and years and years ago, and I'm not going to change it because it's in print. However, what I did do many years ago, probably a year or two after I had that in print, I wrote this note. Under current economic conditions, I feel 20 to 25% is more appropriate than the original 10% in the book of Global Investors, and quoted on in the Investing Rules, pages 301 to 303. At the time the book was published, the economic conditions were more stable, but now that the world is in a war environment, a higher allocation is necessary. And of course, people ask, well, what else would I invest in? And really, that's your call. I'm not going to make this a long diatribe, but I do think that for most people, perhaps 10% is probably sufficient. If you really understand what's going on and you're willing to set aside more because of your belief system, which is similar to mine, then 20 to 25% probably makes more sense. But again, that's your call. I just want to be clear that when I wrote 10%, the economic conditions were far more stable than they are here like 12 years later. And in this environment, I think it's important to have a pretty sizable position in precious metals. That's my thoughts on the topic.